of you are not familiar with SDEA, just a quick bit of information about us. So SDEA, we're a membership organization. We're a nonprofit human resources consulting firm, and we've been around since 1914. Our main goal here is to help employers. So we're on the employer side of things, helping with employer-employee relations, dealing with labor law issues, although we are not attorneys, but things along the lines of wage and hour, leaves of absences, accommodations. We partner maybe either with a HR figure within the company, or for some smaller companies that don't have HR, we work with the owner or the president. We do have an attorney on retainer if there's something that we are unable to answer, or that access is available directly to the member as well. SCA does a lot of training classes. We've been doing these webinars to really keep our employers up to speed, and we are thrilled to have Moss Adams with us today. Providing resources is what we like to do. So check us out if you're unfamiliar with SDEA. But let me introduce you to the real stars of the show. We have Kevin and Andrew from Moss Adams, and a little bit about Moss Adams, Moss Adams is a fully integrated professional services firm, and they're dedicated to assisting their clients with growing, managing, and protecting their prosperity. In addition to their offices in San Diego, they have more than 3,400 professionals across more than 25 other locations. Their strength in the middle market enables them to advise their clients on all intervals of development, from the startup to rapid growth and expansion to transition. Since 2011, the San Diego office has been recognized as one of the top 10 best places to work by the San Diego Business Journal. Congratulations. So our speakers today, so you can get these guys up here so we can see their faces and you can see who we're talking to. We have Kevin Dusi. I hope I said your last name right, Kevin.
You did.
Check. Okay, good.
You got it.
Good. Kevin is a tax partner with Moss Adams, and he has over 15 years of experience in providing tax consulting and compliance services to both public and private companies in technology, life sciences, and manufacturing and distribution industries. He specializes in federal and state tax compliance, international tax consulting, and accounting and consulting for uncertain tax positions. Kevin's expertise lies with clients' multi-state and international operations and has assisted companies with their income tax provision expense computation. All right. And we also have Andrew with us, Andrew Yacoub. How did I do, Andrew?
Not bad. It's Yacoub, but that's all right.
Not great.
We're not formal here.
Okay, good.
Yeah, no worries.
All right, so Andrew is a tax manager at Moss Adams. He's practiced public accounting since 2014. He has vast technical experience in areas of tax prep, review, and assistance with income tax provisions, ASC 740, tax compliance and consulting projects for publicly traded and privately held companies, as well as multinational corporations. Andrew assisted clients with projects such as securing worthless stock losses, testing net operating losses under Section 382, and U.S. international tax issues. So I think we're in good hands after hearing that, and are going to put this in the hands of Kevin and Andrew to take away.
Awesome. Thank you very much.
Go, guys. You're welcome.
So, one thing I will say, one thing that we are not is technology folks, and so we're going to try to make this work. I've got looks like I've got control of what's going on here. Okay, cool. I'm moving stuff around. But thanks for the intro. As as Jennifer was nice enough to read those off, it makes us sound very, very talented. So thank you on those. I will say, a lot of this, it's interesting, as we look at the provisions here and what we're trying to do through this presentation. The CARES Act is something, and we'll just skip to the next slide. But this is something that, even though it's only been out for about a week and a half, because of all of the attention around it, because of all of the I don't want to say hype, but realistically, there's been a lot of hype around it. It feels old already. And so, we're looking at it as being signed into law on the 27th of March. So again, a week ago last Friday. But I can all but guarantee that, there's been, what feels like about 8,000 different email blasts and a bunch of different, bunch of marketing stuff and a bunch of different folks reaching out. So our goal is to kind of today walk through some of the main business tax provisions. Andrew's going to cover that. And then also talk about, some of the ancillary stuff, kind of tax planning, cash flow planning, and of course, everybody's favorite topic right now, which is some of the loan provisions. But with that, I will say, you had our pictures up there. Because this is a webinar and because, it's tougher to put a name to the face, what we've tried to do is at the start of each section, put our little headshot up there so you know kind of who's talking and can attach a face to the voice. But ultimately, Andrew and I work, hand in hand on a lot of stuff together. So either one of us can hopefully address any questions you have. I would encourage everybody to use the Q&A function. If you have any questions, Jennifer will, she'll let us know. She'll raise those to us as questions pop in, but please don't be shy. With, what looks like about 50 attendees right now. That's awesome. And that allows for a lot of interactive discussion if time permits. So I'm going to turn it over to Andrew to start talking about the payroll tax stuff.
Thanks, Kevin.
Hey, can I interrupt real quick on our very professional figuring this out as we go along? Because you guys took control. You now only have access to the Q&A. I do not.
Okay, cool. Well, then it sounds like, we've got control. Andrew, right. I guess, logistically, again, thank you everybody for your patience. We are tax accountants. We're not professional presenters. Andrew, do you want me to click through or do you have control as well? Or am I now the one in charge?
I think you're the one in charge. So
cool.
I might need you to help me out.
Yeah, just let me know when you need me to scroll.
All right, cool. Well, thanks, Kevin. I think that was a great introduction. I mean, as Kevin kind of alluded to, the situation's very fluid. We're getting new guidance daily. I mean, I think we just got some new Q&As on some of the SBA loans Wednesday or Monday, a few days ago. Anyway, let's jump into the payroll tax provisions. But, before I get started on any new legislation, one thing I like to do is take a step back and understand the intent behind the legislation. Doing this helps me to better understand the rules related to the CARES Act or any new legislation. CARES Act as a whole was designed and intended to keep people employed and provide businesses with cash to do so. So when you think about it in that context, it kind of makes a lot of sense why these things are designed the way they are. This leads us to our first topic discussion, which is payroll tax provision of the CARES Act. Next slide, Kevin, please. All right. So the CARES Act section 2301, creates a new refundable employee retention credit for wages paid from March 13th, 2020 through December 31, 2020 by employers that are subject to closure or significant economic downturn during COVID-19. So, again, this credit is a payroll tax credit on your FICA taxes, and it's intended to, again, think about those goals behind the CARES Act, keep people employed. And one of the goals of this credit is, make it cheaper to pay your employees, keep them around. The credit amount takes into account up to 50% of the qualified wages, up to $10,000 per employee. In other words, the maximum credit amount per employee is $5,000. Again, the retention credit applies to the employer's share of Social Security tax, which is 6.2% of wages. One key thing to note here is if you're an employer with less than 100 employees, all wages could qualify for the credit, which is pretty nice. For employers of more than 100 employees, you kind of have to look and see which wages are directly affected by COVID-19. And, the qualified wages in that situation would be wages paid for services and employees not provided during COVID-19 shutdown or a gross receipts decline that we're going to discuss on the next slide. So to be eligible for the retention credit, and these are kind of the key things, a trader business must experience one of the two following COVID-19 related occurrences. And the first one's a little bit more wishy-washy and, gray in my view, is operations were fully or partially suspended on orders from a governmental authority due to a COVID-19 shutdown, or the business experienced a 50% reduction in gross receipts for a calendar quarter as compared to the same calendar quarter in the prior year. And this is the gross receipts decline test. And, the second test is mechanical. You can do the math to figure out if you fit under that, that second criteria. The first criteria is a little bit more gray. For one business, fully or partially suspended may be very easy. I mean, if you have a brick and mortar, a physical front where you have customers coming in daily and you're not able to operate that location any longer, that's clearly a fully or partially suspended shutdown. But what if you're a business that's, indirectly affected? You have less customers, you're not able to get something done as efficiently, your production is somehow disrupted in any way that's more indirect. That seems to fit like a partial shutdown, but there's no clear guidance on what that means. So we're still waiting on guidance on what the partially or fully suspended is. But the test is, we're expecting more guidance and more kind of direction from the IRS on how to figure out what that partially or fully suspended is. They recently released some FAQs, but the FAQs they released were on a restaurant business that was clearly shut down as a result of a COVID-19 stay-at-home order. So that seems more black and white to me. I think we need more guidance on the gray aspect of the partially shut down and what that means. Jumping to, so the retention credit, there's a lot of double dipping provisions preventing taxpayers from double dipping, which makes sense. So if you're getting a credit on an employee for some other opportunity out there, such as, the recently enacted paid family and medical leave or work opportunity tax credit, you're not able to also take this employee retention credit. In addition, if you're taking one of the SBA loans, or particularly the PPP loan, they're not allowing you to also get a credit on some of the loan amounts that are forgiven related to those wages. So there's a little bit of interplay between some of the other provisions in the CARES Act, just something to keep in mind. So coupled with the retention credit is a deferral of payroll taxes, the same Social Security taxes that the credit was eligible for in the prior slides. So these two together, so what that means as a package is for the wages that are not creditable, you can defer paying those until 2021 or 2022. So one thing to consider is that, the nice thing about this is essentially a interest-free loan on those payroll taxes. You're deferring paying that until 2021, 2022, 50% in either year. That's a huge amount of cash potentially, especially if you're a huge wage intense business. And thinking back to the intent of the legislation, again, this is all about keeping your employees employed and keeping them there. Makes sense, make it cheaper for employers to do so. And one of the mechanisms is this payroll tax deferral. Another thing to consider is that, again, the interplay between PPP and these payroll tax provisions. Employer will need to consider whether they intend to take advantage of the payroll protection program, which is the PPP I keep referring to, or these income tax provisions. Unfortunately, you're not able to take advantage of both, which makes sense because the PPP loan, for the most part, will be forgivable, and then they don't want you to double dip on these credits and these deferrals if you're also receiving the forgivable PPP loan from the SBA. And then that leads me into the income tax provision. So the income tax provision, so those were the payroll tax provisions. A quick kind of recap of what the payroll tax provisions were. There's a credit on your FICA taxes, and there's also potentially a deferral if you want to take advantage of it on the remaining amount that's not creditable.
What's the procedure on being able to take advantage of the payroll tax credits?
Great question. So they're planning on redoing the forms, the payroll tax forms that you file every quarter before the Q1 filing to be able to take advantage of this. So that's for the payroll tax deferral. For the payroll credits in particular, there is a form 7200 that just came out, and that form, and we're still getting guidance, is currently in a draft form, but there's instructions out there right now. You can quickly and easily Google form 7200. I'm not a payroll tax filing expert, but from what I can tell you is My quick read of it is you have to file it fairly often throughout the year, and you can file it multiple times to claim credits on the prior quarter's wages. So something to keep in mind, work with your payroll providers. They're probably undergoing the same kind of stuff that we're going through as far as looking into the Form 7200 and Forms 941, 940 to be able to figure out how to take advantage of this, but we're waiting for more guidance from the IRS on how to file those procedurally. You know, I keep joking about my picture. I may have to have aged it a year because by the time I'm out of COVID-19, I don't know if my colleagues will recognize me or not. But anyway, jumping into the income tax provisions.
I think we will all feel the same way.
So the first one, it's a huge one, is NOL modifications. I know it says for corporations, but it also applies to individuals. And to understand what this modification is, you kind of take a step back and understand what the original rule was. And the original rule was for corporations, beginning after the tax reform was enacted at the end of 17, NOLs could no longer be carried back, and they're allowed to be carried forward indefinitely. So what this provision allows for NOLs incurred in 2018, 2019, and 2020 calendar years. So if your fiscal year might be a little bit different, to be carried back 5 years. So a 2018 NOL, for example, could be carried back to 2013. And this yields a lot of benefits. And, you know, again, thinking back to the intent of the legislation, you know, they're trying to get cash in taxpayers' hands. Another added benefit is some of the NOLs would be, you know, considered supercharged in the effect that, you know, carrying the NOL forward for a corporation, for example, would yield a benefit of 21 cents on the dollar because the corporate rate for NOLs going forward is 21%. Whereas if you carry back a 2018 NOL where it was incurred in a 21% year, you're able to carry that back to a 34, 35% year for a corporation. So you got to get this nice rate arbitrage on your net operating loss that you generate in 2018, in addition to getting some cash. And there's some procedures for being able to do this in a fast manner in this tentative refund form, but we've been advising our clients to hold off until we get more guidance from the IRS. As you can imagine, these forms are actually required to be paper filed, which is pretty strange in a lot of ways, but also allows for a lot of difficulty for the IRS, especially because a lot of their service centers are closed. So you could imagine that, you know, some service centers aren't able to receive mail, and for the most part, they're able to receive the mail, and maybe they're not able to process it, or there's a lot of logistical issues with the COVID-19 kind of coupled with the influx of potential tentative refunds to carry back some of the net operating losses.
Hey, Andrew, just to
yeah.
jump in really quick. One, we're getting some questions on the Q&A, which is awesome. One relates to payroll tax, so we'll jump back to that at the end of Andrew's section just to make sure that gets answered. But one thing real quick that popped up that was a question on just a quick explanation on what an NOL is. For those that aren't familiar, that's, you know, essentially when you have a it stands for net operating loss. And that's generally, you know, if you've got a business that's in losses, which, you know, whether you were previously, I think a lot of companies this year are going to be looking at potential losses just due to slowdown economically. But that's what a net operating loss is it's for tax purposes, you know, you're showing a loss. So that's what NOL stands for.
Yeah, thanks, Kevin. I jump into all these acronyms not realizing, you know, I didn't realize this term wasn't defined. But yeah, NOL is net operating losses, which is you had expenses in excess of your revenue that year. And this is also applicable for individuals too. I know it says corporation at the top of the slide again, but for an individual as well that incurred a loss, you're able to carry that back 5 years as well. So the second part, and this one's only for corporations, which is as part of tax reform at the end of 17, NOLs carrying forward, they're able to be carried forward indefinitely, but there's a limitation on how much taxable income you could offset with that net operating loss. And it was limited to 80% on a go-forward basis. Part of CARES Act, they removed that 80% limitation rule for 2018, 2019, 2020. You know, 2018 returns are already filed, so this is a potential for an amended return if you have a corporation, C corporation that you filed where this 80% limitation kicked in and required you to pay some tax. So again, you can see it's a lot of kind of existing things that are in place to allow you to amend or take advantage of existing net operating losses that you weren't able to take advantage of previously because of the new tax reform at the end of 17. They kind of reenacted some of these favorable positions to allow you to get some cash in your hands.
Hey, Andrew, can I interrupt real quickly?
Yeah.
So what if the company had tax credits and that fully offset tax in the tax year that they're carrying back the NOL to?
Thanks, Jennifer. Yeah, that's a tough question. And, you know, when you have tax credits, so let's say in 2013, and in this case, you're carrying back a 2018 net operating loss. The 2013 tax year, you know, you had tax, but it was fully offset by tax credits or maybe mostly offset with tax credits. In that scenario, you know, the net operating loss could still be carried back and it would free up those tax credits in that earlier year. And this is where some modeling is kind of critical to work with your tax provider and potentially model out some of these scenarios, because in the best case scenario, you're able to carry those credits back and get further or carry them forward and free up some more tax that was paid in prior or future periods. In a worst case scenario, maybe that credit's expired. So maybe carrying back that loss would be not advantageous because the credits on a carry forward basis would expire by the time you're able to use them. So there is some modeling done, and you know that kind of leads into another type of provision, which is any net operating losses that you incur, you don't have to carry them back. The default rule is that you do carry them back, but you can waive the ability to carry them back. But it's an all or nothing type test. So if you elect to waive the carry back, that's it. That net operating loss in that period is not able to be carried back. So again, you know, increased benefit for tax rates in prior periods. You know, some other weird kind of nuances, which is kind of alluding to requiring some sort of modeling, is there's a lot of interplay with other income tax provisions that kind of require you to do a modeling exercise. And one quick example, I'm not going to go into the nuances or complexities of the tax law, but let's say you have a deduction, for example, DPAD deduction. If you're not familiar with DPAD, it's the Domestic Production Activities Deduction, which was available for corporations prior to the tax legislation enacted at the end of 17, the tax reform. And that DPAD deduction allowed you to deduct 9% of your taxable income if you're in a domestic manufacturer. But if you take back that NOL to that period, you no longer have taxable income. So it's this phantom deduction on 9% of your taxable income, but now you have no more taxable income. So the rate arbitrage that you thought we're getting is somewhat reduced because now you're losing out on other deductions that are based as a percentage potentially of your taxable income in that period. Another kind of weird nuance thing, there was an error in the original tax reform drafting at the end of 17, which prevented a fiscal year taxpayer with a tax year ending in 2018 from carrying back their NOL under the old rules. If you don't have a fiscal year corporation, then you don't have to worry about this rule, but if you do, this is great news because you can file a tentative refund if you had an NOL in that fiscal period and carry that back 2 years under the old rules. So this one's applicable to individuals, and part of tax reform enacted at the end of 17, you know, NOLs can be carried forward indefinitely, but there's this limitation that individuals have on using those net operating losses flowing to them from their businesses. And this limitation was $250,000 for a single taxpayer or $500,000 for a joint married filing joint taxpayer. So these rules are eliminated for tax years 2018, 2019, 2020. So if you're subject to these rules and it affected you in 2018, for example, you can amend that 2018 return and potentially claim more of the losses flowing through. So taxpayers, yeah, again, reiterating that you may have to file 2018 returns to get these refunds. So again, it's crucial to work with your tax advisor, tax preparer, whoever that may be, that helps you out to see if you can take advantage of any of these provisions. So switching over, so this one's kind of a weird one. It's qualified improvement property. So what this essentially means is if you had leasehold improvements. So there was a glitch, and I keep saying there's glitches in the 2017 tax reform. You kind of see a pattern here is that 2017 tax reform was enacted very quickly, had a lot of drastic changes, and as a result had a bunch of technical errors in the drafting. So part of the CARES Act, they kind of coupled in, and I probably should have explained this earlier, they coupled in a lot of these technical corrections to the tax reform that wasn't intended in the original drafting. So qualified improvement property is essentially leasehold improvements that the taxpayer placed in service, and there's a bunch of different criteria for what that is. But the way the original reform was drafted is it kind of unintentionally kicked out this property from bonus depreciation and a 15-year life, and instead allowed the taxpayer to recover the cost of these leasehold improvements or qualified improvement property as 39-year lived assets. So the CARES Act corrected this error and now allows you to, depreciate those qualified improvement properties over 15 years, and now they're eligible for bonus depreciation. The nuance is, this was intended originally back at the end of 2017 when this is passed. So this is a retroactive correction for tax years 2018, 2019, and 2020. But you may have already filed your 2018 tax returns claiming, a 39-year life on this improvement property. So how do you correct that going forward? And there's a lot of different ways of correcting that error. And this is something where you have to work with your tax advisor to kind of figure out what the most favorable method in your fact pattern is. And I could give you some scenarios of potential ideas that may or may not kind of lead you down one way or another. So let's say, for example, in 2018, you had some qualified improvement property, and let's say it was $50,000. Your current, under the old rules, you filed your 2018 return, you were recovering that over 39 years. Under the correction, which was intended in the original drafting, you would have been able to immediately depreciate that $50,000 and claim a $50,000 deduction on your 2018 return. 2018 in general has lower rates than 2017 and prior years because tax reform was enacted at the end of 17, making tax rates in 18 and forward higher, or lower rather. So, taking a benefit in 2018 may yield you a certain rate benefit depending on what your tax rate is in that year if you go back and amend that 2018 return. But there's some alternatives if you have a business where you can actually claim that missed bonus depreciation in 2019 or 2020 even. And why would you want to do that is, let's say you already know that you're going to be incurring a loss in 2019 or 2020. You want to build on that loss to be able to carry it back to a higher tax rate year. Yeah, so, for 2018, if you already had a loss, maybe you want to amend and carry that back to 2013. But let's say you're in income that year, you'd only yield the rate in that year that you incurred on that income. But in 2019, if you're able to carry that back to 2014, for example, you get a much higher rate benefit on the same deduction. So much more value for your money spent on this qualified leasehold improvements. Another kind of nuance is you can't buy qualified improvement property. It has to be qualified improvement property that you built out yourself. So, again, there's a lot of nuanced rules like that where it'll be important to work with your tax provider to see if the leasehold improvements or property you purchase would qualify for these rules. So Section 163J, so part of tax reform is, Congress lowered the tax rate across the board, especially for C corporations, but as a result, they kind of limited the amount of interest deduction a taxpayer can take on a business return. And this limitation previously was 30% of EBITDA, which is earnings before depreciation, interest, tax, and amortization. And essentially now the deduction is increased to 50% of EBITDA. So, and this is applicable for 2019 and 2020. So this will allow you to deduct more interest in those periods. So this is more applicable to a very heavily leveraged business where interest deductions may have been limited historically, or in 2018, if you have this provision applicable, you'd probably potentially know that you had it applicable because you were surprised that you weren't able to deduct all of your interest. But for 2019, they now allow you to deduct up to 50%. So this will increase potentially a net operating loss if you're going to be incurring a net operating loss in that period and be able to carry that back. A taxpayer could elect to instead use the 30, and there's some reasons why you may or may not want to do that. Because of interplay with other provisions, it may result in you paying more or less tax. Another nice thing is, Congress realized that in 2020, your EBITDA, your tax-based EBITDA might be lower than 2019, so you can elect to use your 2019 EBITDA to deduct more interest in 2020 because they realize that, COVID-19 will be affecting your 2020 operations and potentially have a lower interest limitation in 2020, which is a taxpayer-friendly provision. So some weird nuances for partnerships is partnerships for 2019 and for a partnership taxpayer have to continue to use the 30% interest limitation rules. But there's some nuances in that, partners are able to deduct that 50% in 2020. And, I'm not sure for the reasoning behind, singling out partnerships and only being able to use 30% for 2019, but there is a catch-up provision to catch up partners who are, subject to these rules and catch them up in 2020. So the last topic on the slide is corporate AMT. So as part of the end of tax reform, corporate AMT was eliminated. But if you ever paid corporate AMT historically, you would get a tax credit. So corporate AMT, and what AMT stands for, is alternative minimum tax. And it's essentially a dual system in which you have to compute your taxable income under the regular income tax rules, and then again under these alternative minimum tax rules. And whichever tax is higher, you'd pay that tax. So it forces taxpayer to pay a minimum level of tax. But it's not a permanent difference, and you get a credit for the amount of AMT tax you pay on a carry-forward basis, and you're able to offset tax in a future period when your corporate AMT taxable income is lower than your regular taxable income. Because corporate AMT was eliminated at the end of 17, Congress made the amount of corporate AMT tax that you have carrying forward into 2018 and forward as a refundable credit, meaning every year until 2021, you're able to get a refund of the amount you're not able to use on a tax return in any period. Congress realized that people need cash, so one thing they know that they're going to have to issue this cash out eventually. So now there's a mechanism for being able to do that more quickly, and you could file a refund claim to claim any corporate AMT tax carry forward you have coming into 18 on a 2018 carry forward period. So we're still waiting for guidance on how to do this. There's a form 1139 we think you have to file to do this, but there's no official concrete guidance on how to claim that refund. So stay tuned, but something to keep in mind if you have any corporate AMT tax. So that's the end of my slides. I'm gonna hand it over to Kevin unless there's any questions that came up during the FAQ.
I was going to say so thank you. One question that popped up that I answered, I just typed in the answer, was whether or not slides will be made available. Yes, we'll work with Jennifer and with Dale to make sure that that slides are made available. I'm not sure what the mechanism for sending those out will be, but there's at the tail end, I believe, has our contact info as well. So reach out to Jennifer, reach out to Dale.
Yeah,
or,
we will. We'll make sure that this information is available. We are also recording this, so.
Perfect. Awesome.
Was I supposed to tell you all that beforehand?
Well, again, we're learning as we go, like a lot of the stuff around the CARES Act. Everybody's learning. Another question that popped up, Andrew, and this unfortunately goes back to the payroll tax stuff, and I missed it because I was slow. But the question was, what if you don't know if you're going to be approved for a loan for one of the PPPs? Should you take tax deferral in the meantime? Alternatively, can you retro if you don't do that, can you retro the tax deferral if you don't get the loan you applied for? I'll jump in with a quick answer there. And I think, Andrew mentioned this a few times, and I'll reiterate it. A lot of this is guidance pending. What I have heard, and it's still too new, so no one's really got any definitive answers here. But the deferral is done, on a essentially on a quarter by quarter basis when you're filing your 941s. And so if you don't do it for say you don't do it for Q2, you pay the tax in, and then you determine later that you want to defer. I believe, at filing at the end of the year, you can actually, the design is such that you'll be able to actually try to go back and claim a refund for the amount you're deferring. So you would just true that up at year end. Again, guidance pending. Reach out to your payroll providers if you don't do it in-house. ADP, Paychex, Gusto, they're all they're all, learning this as fast as we are, probably faster in terms of the payroll tax stuff. But hopefully that answers that there. So with that, we'll go to kind of the what I think is the more, probably the more exciting part, but the less tax driven part. So I'm conflicted. And to tie into Andrew's comment about how you're going to have to age his picture, I went the other direction and actually shaved off my beard, so I'd feel younger during all this. So I guess point being, don't ignore the photos to a certain extent. But what I wanted to talk about is really what most people that are reaching out to me, even though again I sit firmly in the tax field. I'm not a banker. I don't pretend to be a banker, but this is still what most of my clients are concerned about. Most of my questions are around the various loan provisions. So I just want to take a couple quick minutes, kind of shotgun through these. Again, I know a lot of you have probably already done the research, so bear with me. But the first one I want to talk about is the economic injury disaster loans. The acronym I've heard is EIDL, so I'll use that. This is something that's been around from before the CARES Act, so it's not a CARES Act provision. And this is something that historically has been more associated with kind of your more traditional acts of God, if you will, hurricanes, tornadoes, floods, earthquakes, that sort of stuff. But as part of this pandemic, they've now included COVID-19 related items as a qualifying disaster, which I think makes sense. These are loans that they're up to $2 million. It's based on, essentially they're working capital loans, and they're based on, payroll, AP, stuff like that you're not able to pay because of the impact. So again, I'm seeing it a lot with, retail clients, food and bev clients where, doors are shut. And so they've got a lot of employees on payroll that they're trying to do right by, but just don't have the wherewithal to do it. They don't have cash coming in. And so that's what, this is originally targeted for. Again, keep in mind, it was before CARES Act. So, interest rates, 3.75%, it's up to 30-year loans. So long-term on there. The terms are done case by case. My understanding is right now it's, most everybody's able to get the 30-year and 3.75%. One of the advantages to this is that this is something you apply for online straight through the SBA. So you don't need to go through a bank. You can actually go, the website's on the bottom left of this slide. And again, we'll have the slides. We'll have everybody have access to that. But if you're a small business, which generally speaking is that 500 employee cap that Andrew talked about, there's some exceptions. But generally speaking, it's that 500 employee cap. Then you can go onto that link right there and actually apply online. So that's the EIDL. Part of that is, is the economic injury disaster advance loan. They call this a loan. It's $10,000. It's once you go through a successful application for the EIDL, it's a loan advance up to 10 grand, but it's an advance that doesn't have to be repaid. So really it's more of a grant. So it's done through the same website at disasterloan.sba.gov. And it's, available to anybody that's applying for the EIDL can apply for this $10,000 advance. And again, it's something that doesn't have to be repaid. The third prong is the SBA bridge loans. This is designed to be something that allows you to access a little bit more cash, $25K in this case, with, in theory, a lot less paperwork. One thing to consider here is that you have to have a business relationship with an SBA Express lender. Most of the major banks in town, from what I understand, do qualify as SBA Express. So that's, if you've got an existing banking relationship, great, just reach out to them. The goal of this is it's $25K that's going to bridge the gap between today and when you apply, or when you apply and when you receive the EIDL. And so, you go on, you apply for the $2 million EIDL. And in the meantime, it's like, well, I still need cash now, and I still have to have some liquidity. So it's an ability to get, to essentially access $25K. So again, work with your lender. Make sure that they're an express lender, but it's something that my understanding is it's easy to get.
Hey, Kevin.
Yeah.
Now, we got a question that came in, and I feel like it's an important one. Will small nonprofits be eligible for these loans from the SBA?
So my understanding is yes. I just lost my scroll. So yeah, it's basically, I know on the SBA loans, it's basically, and I believe the EIDL has the same one. So as we're looking at the PPP here, this is for businesses and 501c3s. And there's some carve outs for the type of nonprofits. But yes, my understanding is on the SBA loans, the 7A loans, that those are going to be available for not-for-profits. I will confess, I don't personally have a large not-for-profit practice, so I'll confirm that, and I'll get that back to, I'll get a more solid answer on the EIDLs, but the SBA loans do have a specific carve-out, as you can see on the slide here, for 501c3s. So there's that same 500 employee limitation for not-for-profits, which most of the ones, most of the smaller ones in town will qualify for that. But, again, I'll get a more solid answer on that, given that I don't practice a lot in the not-for-profit space. So with that, I'll launch a little more fully into the, whether you want to call this the PPP. Oftentimes it's referred to simply as the SBA loan or the 7A loan. This is part of the CARES Act, where they carved out a big chunk, $350 billion for the loan program. As Andrew talked about with the payroll credits, the goal here is to keep people employed, to keep people actually receiving paychecks. That's why it's called the Paycheck Protection. And so the big plus on this is there are loan provisions that will allow this to essentially convert into a grant. So if you get the loan and you do it the right way and you use it for the right stuff, there's loan forgiveness provisions. So in terms of dollar amounts, there's essentially a cap of, it's the lesser of $10 million or 2.5 times your average monthly payroll for the last 12 months. So most of us on this call, I'm sure, will be capped at that 2.5 times payroll figure. But so that's the maximum amount that you can apply for. It's just a mathematical exercise, so you can just tear through it that way. The advantage here, some items to talk about: physician practices. Obviously, doctors very important. They're not subject to that $500 or 500 employee limit. Hospitality and food industries, if they're under certain codes, I believe it's a NAICS code, then you're actually allowed to look at it location by location. So if you're thinking, for hotels, they've got 3 properties, each one has 400 employees. Together, that would not qualify. But the intent here is to, if those hotels are still going to be paying people, the intent is to get them the money. So the SBA said, okay, we're going to allow that to qualify. We'll look at it on a location by location case. So, and the last thing is for franchisees, you look at it from if you're in the National Franchise Directory, you look at the franchisee store level versus looking at the overall franchisor. So possibility to have it done a little better there.
So Andrew, this is Jennifer, or Kevin, sorry.
Yep.
Kevin, is this what Andrew alluded to earlier about being able to apply for the EIDL and the PPP at the same time?
Kind of. There's a lot of provisions, and Andrew hit on the kind of the double dipping, where if you apply for one, you can't necessarily use it for the other. Andrew talked about if you are taking you can't necessarily take the payroll deferral or the credits on amounts paid for out of this 7A loan. For EIDLs and SBA loans, because they're 2 different things, you can apply for both, but what you can't do is use funds for both to pay for the same thing. And in I believe the requirement is if you have an EIDL and then you apply for an SBA loan, you actually, what they expect you to do is, to the extent you're using EIDL funds for the 7A approved purpose, you actually roll that dollar amount into the loan. So you can do both, but there's some interplay, and that's where it's really, really important that you're talking to your banks. My understanding is on the, and again, keep in mind, not a banker, but my understanding is on the application for the 7A loan, there's not an actual spot where it asks you, do you already have an EIDL? And so it's just something to you know, so it doesn't prohibit you from getting it if you already have one, but make sure your lender's aware. So just good food for thought.
Thank you.
So I want to try to leave, because we got a couple more questions. I want to try to leave a little bit of time. This is what everybody's excited about. So I'm going to make sure I hit the debt forgiveness part, and then some of the stuff at the end we'll churn through real quick. But what makes everybody super excited about the 7A loans is this opportunity for debt forgiveness. And, you know, generally speaking, from a tax perspective, when you have debt forgiveness, the IRS still wants their piece, right? They say, okay, well, that's great, but we're still going to include that in taxable income because you're essentially getting a benefit for walking away from debt. This is kind of the best of all worlds. You get the cash, you don't have to pay it back, and the IRS has even said, yeah, we're going to exclude that from taxable income. So it's a huge, huge benefit. That is assuming that, you know, the proceeds that you get, you have to use for the right stuff. And in this case, it's going to be payroll cost. It's going to be interest, rent, utilities on stuff that existed before a certain timeline. In this case, they say, okay, it had to be in existence before February 15th. What they don't want is, you know, you to enter into new contracts thinking that you're going to get this loan and be able to pay off part of it. So as long as the obligations were in existence before February 15th, and that's going to be a lease agreement, for utilities, as long as, you know, the service was already in existence before Feb 15, interest on long-term obligations, all the same timeline. So the idea is you get the loan, and then during the covered period, which is the 8-week period beginning with the origination of the loan. So once you get funds, then during that 8-week period, amounts, and there's limitations we'll talk about on the next slide, but generally speaking, amounts used for those buckets are going to be excludable from income. So again, big win. Some limitations on that tax-free loan forgiveness is mostly around workforce. You know, the 75% of the funds need to be on payroll related costs. So that's not on the slide, but just be aware that you know, because the loan is based on payroll count or payroll spend, they also then want you to turn around and make sure you're using it on payroll. Things that will reduce your COD from a tax-free perspective is going to be the reductions in workforce. So if you're laying off people, they'll look at your average head count kind of before and after, and that's just a mathematical exercise. And then also reduced pay. So what they don't want you doing is, you know, if you've got people that are, you know, say they're earning 80 grand a year, and you say, okay, well, we're going to keep you on payroll, but we're only going to pay you half. That will result in certain amounts not being forgiven as well. So what they want is you to keep payroll amounts at 75% of what they were making before. And we're starting to get a lot of questions, which I expected. So I'm going to try to churn through relatively quickly so we can try to address some of those. But I will say, if we don't get to it, we will, because we're going to have a hard stop at 10 o'clock. If we don't get to it, we will circle back with everybody. So if we don't get your question answered, we'll get the answers out and to the group. So again, application needs to be through an SBA lender, you know, all of that stuff. So this is, when you get the slides, if you're comparing the two, this is the slide that you want to look at in terms of just a quick and dirty, what's the difference between the PPP and the EIDL. This walks through all the high points: loan amounts, repayment terms, what it's used for. You know, one thing that I didn't hit on is, you know, the EIDL does have some collateral requirements, potentially some personal guarantee requirements that the 7A loan doesn't have. So it's actually, the 7A is less restrictive. So keep that in mind. But again, you know, this is the slide you want to refer to if you're looking at kind of comparing the two. So the last handful of slides, I'm going to just touch on briefly. I'll flip through them just so you know, everybody can see them. But these are all recommendations that normally we would make anyways to our clients. You know, it talks about, you know, cash flow budgets, financial projections. This is all stuff that just as good business sense you should be doing. What's changing now is the cadence. So before we'd say, okay, depending on your business, you may want to be doing cash flow projections for a month or for a quarter or for, you know, for a year if, you know, you have a good idea from a cash flow perspective. Now we're saying, you know what, you really should be looking at these weekly, if not more. You know, part of the next slide talks about, you know, from a cash flow perspective, if you have an element of your business that's online and an element that's kind of a storefront, you know, consider, do you discount your online stuff to try to get additional customers, additional cash flow? If you're sitting on inventory that would provide liquidity by getting it out through an e-commerce you know, function, do you want to offer discounts to try to accelerate that? You know, part of this is working with all of your vendors, suppliers, landlords, all of that to talk about, you know, what are the appropriate, you know, modifications you need for leases, for debt, because people right now are generally speaking willing to work with you and modify some of those things. So be having the conversation. Kind of the almost skipped kind of the last one, if I can scroll back, is, you know, daily bank recs. You know, consider factoring, looking at insurance, all of that stuff. Again, things you should be doing as normal course of business. The main difference now is cadence, and it needs to be a lot faster. And with that, again, I know I shotgunned through that. We're going to have the slides available, but we've got some good questions building up that I want to get to. Last selfish plug for Moss Adams is everybody's got questions on COVID-19. There's new stuff coming out daily. We've got a website, the link's right there, that we're updating as often as stuff comes out, that we'll talk about the different things that have been passed, things to think about for business, you know, all of the different things that are hitting from a COVID-19 perspective. So, you know, take a chance to spend a few minutes, go to the website, take a look. A lot of good articles, a lot of good resources, and we are updating it daily. So with that, going to try to go to the Q&A. There's a handful of chat stuff, mostly asking for, okay, all the chat stuff looks to be slides. So great, we'll get those out. Let's see if we can answer some questions. So do you know if the EIDL has payroll percent requirement like the PPP has a 75% requirement? My understanding is no. Main reason for that is that there's no forgiveness element. The 75%, the 75% was, you know, to apply for the debt forgiveness piece. In theory, on the SBA, the 7A loans, you don't need to use that for 75% payroll. You just won't get the debt forgiveness chunk then. So keep that in mind. Trying to get these in no particular order. I applied for the EIDL 10 days ago. Thought response time is 3 days. Is this normal or is there a problem? I would, well, again, you know, one of the things, if you're looking online or reading, like I think Wall Street Journal had something on this, New York Times had something on this. Everybody is frustrated with how slow it seems to be from a funding perspective. The goal was to have that within 3 days. So it might be worth, you know, if you can get in touch with somebody at the SBA, might be worth following up. But one of the common complaints and one of the things they're looking at for, you know, for round 4 of the economic stimulus is how to make sure that the funding and the everything else is a lot smoother. Because right now it's taking forever. So I would say, unfortunately, I think that's normal, but if you can get a hold of somebody, please do. Debt forgiveness, does this include draws that the owners take? Partners are not part of payroll and only takes draws. I believe there's an element, and this is where, again, my practice is more on the corporate side. So we will confirm on this, but to the extent that there's guaranteed payments or SE income, I believe that is something that that could potentially qualify for debt forgiveness, but I don't know the definitive answer on that. So we will follow up on that and circle back. So my understanding is an element of that, yes, but I don't want to necessarily, swear on my life because that's not my area of practice. So we'll find out. Patrick can get that back to you. Kathleen is asking if any of the idle is forgivable. If it remains an idle, no. So the idle itself, it's a up to 30-year term, 3.75%, a little bit lower for not-for-profits, I believe. That is it's just a standard working capital loan. So none of that is forgivable. However, if you have an idle and then you apply for one of the 7A loans, you can roll in amounts of the idle that you used on the appropriate expenditures, roll that into the 7A loan, and then apply and then have some debt forgiveness that way. So if it remains an idle, no. If you roll it into the 7A, then it's potentially forgivable. Man, I think they're going faster than I can answer. We'll do one more, and then we'll commit to getting answers back on the rest. Is there any indication how you prove you use the money for those specific costs? Do you need to set up a separate bank account to segregate the money and show what money was used for? As of yet, nothing that I've seen. Again, we're in most cases, people aren't, loans aren't even funded yet. So not any guidance on how to prove that you've spent it on certain things. I think the fact that it's going to payroll costs, that is something you're going to be able to prove via your payroll tax reporting. Even if you're electing for deferral, things like that, you're still going to have to call out the amount of wages that you've paid. So I think that will be easy. I'm not sure on the rents, utilities, interest. My understanding, again, is that they're trying to make this user-friendly, but there just isn't the guidance yet. So I would suggest, just as a good business course, maybe not a separate bank account. If you can, that's ideal, and then just only use that for applicable funds or for applicable purposes. But at the very least, just whether that's a Excel sheet or a separate account in QuickBooks, whatever your accounting system is, however you want to do it, track that separately. But the big chunk, the 75% for payroll costs, should be something you can tie back directly to your payroll tax reporting. So, Erica, if that doesn't quite answer the question, just let us know afterwards, and we'll try to get you some more info. But I think that's one of the ones where we will indicate guidance pending. So, with that, I'm gonna, again, we'll get answers back on the other questions. So thank you guys for submitting them. I know originally we expected we'd have more time to answer all the questions, but the good part is we're getting a lot of them. So we'll get those back to you.
Right.
Just to rehash, here's our contact stuff. Please reach out to us if you have, if you have further questions. Again, we'll make the slides available. I believe Jennifer's gonna take charge on getting those out to everybody.
Yes.
But we will be doing follow-ups. So with that, I will let go of control and turn it back to Jennifer.
All right, you guys. Well, thank you both, Kevin and Andrew, very much for answering a bunch of questions and providing a bunch of information that is out of our area of expertise for sure. So, I encourage everybody to go to Moss Adams' website that's on the slides, which we will be providing to you guys, to check out the information that they're updating. That's on the tax side, SDEA's website. So I'll do my shameless plug too at sdeahr.org. We've got more of the HR side of things on there, and resources and updates on the leaves and the paid sick leave and all that kind of stuff. So check us out there for that. I know one thing we can see we've got in common, whether we're dealing with taxes or HR, that we're kind of dealing with a lot of unknown. And I probably have not used the word fluid more in my life than I have in the last few weeks. But I guess we're all in this together and figuring it out. So we'll work with, Moss Adams will work with Kevin and Andrew to get the questions, and we'll have the slides. And like I said, we recorded this, so we will have that information available on SDEA's YouTube channel, and we'll provide that link out to everybody. So thank you again, and I think that's it. And I hope everybody has a very safe and healthy rest of your day.
Awesome. Thanks, everybody. Jennifer, I guess just logistically, as people are dropping off,
Yes.
I don't know enough about Zoom to know if it's going to retain the questions when we close the meeting. So is that?
Yes, it will. And that's why we always encourage people to go through the Q&A and not the chat, because I don't
Okay.
think the chat saves, but the Q&A does.
Okay. Is it possible
So-
for you to email those to Andrew and I so that we can
Yeah.
make sure we address them? Perfect.
Yes, for sure.
Perfect. Perfect. Awesome.
Okay. Thank you
Thanks
guys
for
very
that.
much.
Thanks, everybody.
All right. We'll be in touch. Bye.